welcome to your Mortgage Insider Update for this week. We start off the first full week in January with a little bit of a bounce back in interest rates after hitting a bottom at the end of the year. So taking a look at the charts this morning, we do have a lot of upcoming news. We'll take a look at the CPI and the PPI reports coming out later in the week, and let's take a look at the charts. We start this week off with the 10-year Treasury down 7 basis points, which is vastly improved from where it started the day, following up with Friday's jobs report, a little bit stronger than expected, with over 215,000 jobs created, and the unemployment rate staying steady at 3.7%. We did see a little bit of a pullback higher in interest rates, but to start this week off, 7 basis point reduction, 23 basis points improvement in the mortgage-backed securities. As we see, we did hit the Fibonacci retracement level right at the 200-day and the 25-day average, right as they peaked and they hit each other yesterday, bouncing off that today, coming down. This is a great sign as we survived the jobs report. When we see mortgage-backed securities up 25 basis points, that improvement, same sort of thing. We have seen the high point, that is the lowest point in interest rates back at the very end of December 28th, come back a little bit, but hit the 25-day average, and we're bouncing back this morning. Looks like a good start to the year. So on a positive note, we are starting the year off flat from the high point in mortgage bonds, low point in interest rates, at least over the last 6 months, just in the last few weeks. We are looking into the future here a little bit with the Federal Reserve scheduled to put some kind of a rate reduction or rate cut into their calculus. That might not be until the second or even third quarter of the year. A lot of that's going to depend on how strong or how weak the economic indicators coming, such as the CPI and inflation, as well as the jobs data coming into the future. The first quarter of the year, usually not that strong in the economy. GDP's typically a little bit weaker because of cold temperatures. Across the United States have been a lot of big weather events, and that will start to slow things down as we see the numbers over the next few months. But we shall see. It's anyone's guess when the Federal Reserve start to cut rates, but that'll be hopefully an indicator to get us back down into the mid to low 6% range. Right now we're hovering right under 7% as far as mortgage rates go. Have yourself a great week.